One piece of advice I always give is that all dividend investors should hold at least one diversified dividend growth ETF. That's regardless if you're young and investing for growth or if you're retired and are looking for more income. Holding at least one dividend growth ETF ensures that your money will continue to grow to help combat inflation. But there's a lot of different ETF choices that exist from a lot of different companies, and not all of these funds are created equal. They all have different strategies and their own sector allocations that can be pretty different from one another. So in today's video, we're going to examine the most popular dividend growth ETFs and try and determine which one has provided the overall superior returns over time. So with that being said, let's go ahead and get started. These are going to be the funds that we're going to examine today. The first is the Vanguard Dividend Appreciation ETF, ticker symbol VIG. This is Vanguard's largest dividend ETF and currently the 15th largest ETF in the world by assets under management. We'll also look at the Vanguard High Dividend Yield Index ETF, ticker symbol VYM, which is their second largest dividend ETF. The third fund will be the Schwab US Dividend Equity ETF, ticker symbol SCHD. This fund has become pretty popular and it's close to overtaking VYM in terms of assets, despite not being around as long as VYM has. It's also Schwab's most popular ETF by a pretty sizable amount. We'll also look at the iShares Core Dividend Growth ETF, ticker symbol DGRO, and the Spider S&P Dividend ETF, ticker SDY. These 5 ETFs are the most popular dividend growth ETFs that exist according to VettaFi, formerly known as ETF Database. And as I mentioned earlier, these funds can differ in terms of sector allocations, expense ratios, and growth rate. Although all these funds are geared towards growth to a certain degree, some are more focused on growth than others, if that makes sense. For example, some of them hold more tech companies, which almost never pay good dividends but can potentially have more really good share price growth. So we'll start by looking at some surface level information, starting with current dividend yield. VIG currently offers a yield of 1.92%, VYM currently has a yield of 3.4%, SCHD has an even higher yield of 3.86% as of the making of this video. DGRO currently has a yield of 2.78% and SDY has a yield of 2.75%. All this information was gathered from these funds' websites and they're all the 30-day yields and not the trailing 12-month yields. This information changes on a daily basis, so things can be significantly different depending on when you happen to be watching this video. But right now, the highest paying dividend growth ETF would be SCHD, followed by VYM at 3.4%. Another important metric to look at is dividend growth. For this comparison, we're going to look at the 5-year dividend growth rate for each fund, which I'll be taking from Seeking Alpha. These are the rankings of each of these ETFs. The clear winner in this category would be SCHD at 13.69%, followed by DGRO at a distant 9.66%. So right now, SCHD is looking like a promising contender for best dividend growth ETF, but there's still a lot of other factors to consider that we'll need to take a look at, including the safety and the overall performance of their ETF. We'll now examine each fund's holdings. When it comes to the safety of an ETF, it's always good to be really well diversified. The more diversified an ETF is across different sectors and the number of holdings that it has, the better. In this category, the winner is the Vanguard High Dividend Yield Index ETF, ticker symbol VYM, at 455 holdings. Second is the iShares Core Dividend Growth ETF, ticker DGRO, at 434. SCHD in this category comes in dead last with just 104 holdings as of November 16th. This entails a couple things. Because SCHD holds fewer investments, if just a handful of them perform badly, then it'll bring down the performance of SCHD significantly more than a fund like VYM, which holds 4 times as many investments. A dividend cut from one of SCHD's largest holdings could slow down the dividend growth more significantly than any other ETF we've been looking at. Therefore, when speaking in terms of diversification, the winner in this category is VYM. Let's now look at each fund's expense ratio. The expense ratio refers to how much a fund's assets are used towards administrative costs and other operating expenses. Because an expense ratio reduces a fund's assets, it reduces the returns investors receive. For a lot of people, having a low expense ratio is very important because it means the company is paying themselves less and are giving investors more of the returns that it receives. Vanguard's been well known for decades for having some of the cheapest mutual funds and ETFs in the industry, but more recently, other companies have been able to match their low-cost investments. Looking at each fund's website, as of the making of this video, these are the current expense ratios for each of these funds. There's a 3-way tie going on for cheapest ETF, with VIG, VYM, and SCHD all having an expense ratio of just 6 basis points. DGRO is slightly more expensive at 0.08, and for some reason, SDY is significantly more expensive at 0.35%. As I've mentioned in the past, it's my belief that if an investment does come with a higher expense ratio, but it either provides superior returns or it functions in a way that you're looking for, then paying a higher fee could be worth it. For example, if Fund A charges 0.10% and another fund, Fund B, charges 0.12%, but Fund B outperforms A by a sizable amount, then the more expensive fund could be worth considering. Another example would be if you're looking for a monthly paying investment. If you enjoy getting dividends monthly and the monthly paying investment comes with a higher expense ratio, then again, it might be worth considering paying more. Unfortunately, in this case, none of these funds currently pay monthly dividends. Now that we've looked at some of the common metrics for these funds, let's now calculate the total return for each and see which one comes out on top. To really analyze the best performer, you have to take into account not just the share price, but the dividends as well. This is probably the biggest mistake I see critics of dividend investing make, which is that they only look at the share price of dividend-paying investments without taking into account the distributions. Most dividend-paying investments do have less share price growth, and often what I see is that some people will compare the share price of an S&P 500 ETF with a dividend-focused ETF and say, look, the dividend-paying investment shows less share price growth, therefore it's a bad investment. But this obviously isn't a fair statement because they don't take into account the dividends being paid and reinvested back into the fund. It's incredibly hard and time-consuming to calculate the total return of a dividend-paying stock manually, which is why whenever you're analyzing a dividend-paying investment, you need to use a drip calculator. The website I use for this is on Dividend Channel. They have this really handy calculator that tells you the total return of a dividend investment if you chose to reinvest your dividends or not. This calculator only goes back to 1995, and it also doesn't account for some certain investment types like equity-linked notes, but it's still the best drip calculator that I've come across. For this comparison, we're going to look at the total return of a $10,000 investment into each fund 10 years ago from today, with all the dividends being reinvested. First up is VYM, which as you can see has provided an average annual return of 8.79% or a total return of 132.14% in a decade. Followed by VYM is SDY, which slightly beats them out. They provided an almost identical return at 132.4% or an average annual return of 8.8%. A $10,000 investment in SDY would now be worth $23,242.83, which is still great. Followed by them we have VIG, or the Vanguard Dividend Appreciation ETF. In the course of a decade, it's given investors an average annual return of 10.32%, which is quite a bit better than what we've seen so far. That would leave you with a total of 166.94% in total gains. Coming in after VIG is SCHD. This ETF barely beats out VIG with an average annual return of 10.34% and 167.49% total return. Then finally, the last dividend growth ETF is DGRO, which as you can see has offered the highest annual return from the rest. But there's a couple things to keep in mind. This ETF hasn't been around yet for 10 years. You can see that DGRO has only existed since June of 2014. Also, it hasn't offered the overall better return since it hasn't been around as long. SCHD's total return was 167.49%, whereas this ETF is only 154.38% after 9.5 years. Based on this information though, if this fund continues to perform as well as it could potentially beat SCHD. It looks like it would have to earn an additional 13% over SCHD by June of next year, which isn't impossible, but in my opinion is very unlikely. So even though DGRO doesn't offer us 10 years of performance, this calculator still gives it the victory in terms of long-term performance. So after looking at all these metrics, what can we gather from this information? There's no doubt that any single one of these investments would have been good for a portfolio. You couldn't go wrong in investing in any of these ETFs if you were looking for share price and dividend growth. But I think it largely depends on what you're looking for. If you want growth from a very diversified and potentially safer investment, then you might lean towards VYM for its larger portfolio. If you're looking for the cheapest fund, you have 3 different options to consider since the top 3 all have the same expense ratio. If you're looking to receive the most quarterly dividend income right now for your money, then you might lean towards SCHD. Or if you're looking for the overall better total return, then potentially DGRO or SCHD. But again, I would like to stress that I believe that every dividend investor should hold at least one of these investments. How much you allocate towards it depends on your age, your goals, and honestly just your personal preferences. It adds a lot of diversification to a portfolio that might be lacking holdings in other sectors that typically don't pay a lot of dividends. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.